My name is Steve McMenamin. I'd like to welcome you to today's event, which is part of the continuing series of the Founders Council of the Greenwich Roundtable. Our topic this evening, Best Practices in Alternative Investing, Portfolio Construction, is a very special occasion where we release our point of view to the world. It's been over 2 years when we held a symposium of this kind. We first released, or I should say, when we released Best Practices in Due Diligence for Fixed Income and Credit, just weeks ahead of the perfect storm that brought down those markets. Today we're back with Alex Weiler again, moderating and speaking. And as you all know, we love gray hair. We've got 3 of the most seasoned investors, all legendary practitioners. I'll briefly introduce them after I say this. Our speakers' views are their own and may not necessarily represent the views of our members or our trustees. Sitting to Alex's left, Ed Barksdale is the Chief Executive of Federal Street Partners, one of the best hedge fund of funds in the business. Ed is one of the pioneers in many respects. He was the CEO of Northern Trust Global Advisors and a partner in the fabled pension consultant Rogers, Casey, and Barksdale, as well as a co-founder of Callan Associates. He's a trustee of the Greenwich Roundtable and a board member of the Duke Management Company. Ed is a primary author of this best practices study.
That's a stretch.
He's always understated, too, I should say. Sitting to Ed's left, Rusty Olson ran the investments of Eastman Kodak Company's pension fund for over 25 years, one of the nation's best-performing corporate pension funds. He retired in 2000, and today Rusty's a consultant on institutional investing. He has since written 4 books. His book, Investing in Pension Funds and Endowments, Tools for the New Independent Fiduciary, is required reading. Rusty is also one of the primary authors of this best practices study. Sitting to Rusty's left, Bob Prince is the co-chief investment officer of Bridgewater Associates, a firm that at $70 billion of AUM is not only a force of nature but also a thought leader, doing important research for the benefit of the investor community, and that's why we like him. Bob Prince shares responsibility with Ray Dalio and Greg Jensen for Bridgewater's fundamental and systematic investment processes. Bridgewater's innovative investment views on portfolio construction deeply influenced this best practices study. And sitting to my left, the moderator of the Founders Council tonight is Alex Weiler. Alex is a senior portfolio manager at the Canada Investment Board, and before that he was a portfolio strategist at Weyerhaeuser and Tremont Capital. 3 years ago, Alex was the primary author of Best Practices in Due Diligence for Fixed Income and Credit Strategies. That study was highly respected, earning Alex a private audience with Chairman Bernanke. Today, Alex led the Best Practices Working Group to produce this comprehensive study on portfolio construction. Alex conducted the initial focus groups and went on to write some original insights, which he'll describe tonight. Alex, before you do that, would you set the stage for today's discussion?
Sure. Thanks, Steve. It was about 2 years ago that I was sitting on this dais introducing the final best practices in hedge fund due diligence on fixed income and credit strategies, which, as Steve mentioned, to say the timing was good was a slight understatement. But hopefully the advice that was heard that evening and that we wrote in the publication was even better. And I'll let you decide. And here's a couple comments that were made at that time, which is the first section of the document's about getting adequate returns for the risk you're taking. Ultimately, there's a few red flags that we highlighted. The notion of increasing leverage applied to decreasing opportunity sets hasn't ended well ever in history and won't end well this cycle either. I think almost every one of us who's managing a portfolio has experienced some aspect of that over the last year. We were lucky to have Brian Miller, the head trader of Elliott, add as a corollary to that and to lay out the case that the best way to address this was to short AAA pieces of RMBS and CDOs, which those of us who did so in our portfolio made our institutions and clients very happy. And that's the great thing about the Greenwich Roundtable, which is you get to listen to some of the best in the business, which you have here tonight. And at a time when these insights are probably more valuable than others. It was around then that we started to ask ourselves, how are people positioned? If we do see these accelerating risks, are their clients and institutions positioned the right way? And are people thinking about putting together their portfolios in the right way? And I have to admit that at that point, we, as we have always been, were inspired by the late Peter Bernstein. I guess we're banding around probably St. Peter by now. He really was our muse and mentor throughout this, something that I hope he'd be flattered by, and I hope he's proud of the publication. I'll read a section from one of his last economic and portfolio strategy, for those of you who had the newsletter. It came out in March. And he said, "Longtime readers of this publication will be aware that I've been an outspoken and early opponent of the policy portfolio. At a conference back in 2003, I declared investment policy in today's environment should be opportunistic, to be played more by ear than by rigid policy allocations. The time has come to take off the policy portfolio corset and breathe freely for the indefinite future, not just for today's world." As he said, this position ignited an uproar in the world of institutional investing far greater than I could have anticipated. In the end, however, it turned out only to be an uproar. To my knowledge, nobody has taken up my advice. We're hoping that this publication helps some institutions that would benefit to take up this advice. There were three main points that we raised in this publication, and as with all of the best practices publications put out by the Roundtable, the goal is to codify much of the knowledge that has been passed down from skilled allocator and skilled investor to in what has largely been an oral tradition. And so it's always been a blend of hard knowledge, but also more importantly, a way of thinking about the issues around what we do for a living. And asked in a number of the media interviews we've had how our advice differs from Mr. David Swenson's, there's really probably three things to highlight. First, David correctly cautions to not try some of this at home. At the Roundtable, we're hoping to promote the best practices and help people to raise their game a little bit, even to help benefit their institution. Secondly, we decided to focus a lot on risk management and liquidity, an area that's been quite important to most people. And third, if you look at it, it is certainly much shorter than David's publication, but hopefully not lacking in any of the content of it. There were three main areas that we highlighted. Each of the speakers are going to touch on one of them tonight. The first is that, as Peter Bernstein had mentioned, asset allocation should be a lot more dynamic. And there's two main points on that. First, the notion that we highlight on page 26, which is that the labels applied, the notion of an asset class has become really divorced from the fundamentals that underlie it. And we really think that's the best way to think about investing, is to look at assets, how they behave in the marketplace. So ultimately, whether you're investing in private equity or public equity or corporate credit or venture capital or high yield or distressed, you're playing off of corporate earnings and cash flows. Now, at different points in the cycle, you'll do better in each of those activities, but the fact of the matter is, ultimately, if you're a long-term investor, it's really only a matter of timing that differentiates those things. And growth is what's going to drive most people's portfolios. The second is that there's two risks then in that scenario: inflation and deflation. The latter, which we've experienced pretty severely, at least fears around that. Bob Prince and certainly philosophically, we were inspired by Bridgewater in the notion that environment does matter, which we bring up in the publication. The second piece is the overall philosophy that the Roundtable espouses, which is, first, that it's about collecting quality opportunistically. When you're investing in alternatives, it is, as one of the interviews pointed out, it's an access class. It's not really an asset class. There aren't that many really talented investment groups out there. And the difference between a top and bottom tier in alternatives is substantial. And so you need to get that right. And secondly, portfolio management is about risk management. And some of those points will get highlighted tonight. And then finally, the last point we wanted to highlight was that good governance matters. I think one of the comments that had been made, And we highlighted in the publication is that it's important to do what's right for your institution. What Yale does may be right for Yale, but if you're not Yale, it's likely not right for you. Every one of the institutions or clients we represent have their needs, and there's an appropriate portfolio for that. And secondly, that our goal is really that of a sacred trust to grow the real corpus that we've been entrusted with. We're fortunate at the Canada Pension Plan, since we're Social Security, to have a fairly long time horizon. And we always talk about not having the guy who's going to be in our seat in 20 years sit there and curse us as the gold standard for how we should be investing. And that's some of the philosophy that we hope to bring to everybody with this publication. With that, you're here not to listen to me, but to the three gentlemen seated to my left. And so I think I'll, at this point, pass the microphone over to Bob Prince from Bridgewater.
To Rusty.
Oh, to Rusty? Okay.
Rusty, yeah.
And we'll go from there. This is why I say he runs the place.
This is one of the essences of this publication is in the terms new school and old school. And it can be misinterpreted to mean that old school is out, new school is in. They are not mutually exclusive. Thank you. Old school is the quantitative ways to develop optimum asset allocations through multi-factor models such as those of a common fund or mean variance or asset liability studies. They all are still useful devices to employ, especially if they're built around Monte Carlo simulations. But the problem is they all have limitations, and many users don't understand and appreciate fully the limitations they have. For example, they're all based on assumptions for return, volatility, and correlations for each asset class. Nobody can get those assumptions right. You need to understand that before you begin using these devices. I've seen multiple people come up with one set of assumptions and give you the supposedly optimum portfolio based on those assumptions. I think what needs to be done is to use many iterations of very different assumptions, because you want not the best asset allocation under a particular set of assumptions, but one that's going to hold up reasonably well under a wide variety of reasonable assumptions. Also, if you are including private investments in your asset allocation, which a good investor should be doing, they're very difficult to include effectively because they don't have quarterly market values or even annual market values to give you good data on what has happened in the way of diversification and correlations. If you look at real estate, do you take what the index says for private real estate, or do you recognize that that's much too low volatility and probably too low correlations? Make some adjustments in that. All of those assume that you're going to rebalance to that asset allocation each year. That's built into the process. Well, it's very difficult to do with private investments. You need to understand it requires some qualitative overlay on that. And then mean variance optimizers have a further problem in that they are based on bell curves. Not everything works like a bell curve. And we all really were inundated with the flat left tails this past year. You also may come up with a nice asset allocation, but is it going to give you the staying power so you can maintain that when 2008s come along? You want diversification. That has not changed. What is referred to as the one free lunch in investing is diversification broadly, and you want that, and these help you get it. But what this publication has been trying to do is take you one step further and recognize that all of these different asset classes react differently under different economic conditions. And you want to have some hedges for inflationary scenario, hedges for deflationary scenario, as well as a structure that will let you take advantage of growth. Obviously, the best way of implementing that is to be able to discern what kind of an economic scenario we're moving into and how much of that is already discounted in the markets. That is the ideal way of doing it. I find that personally very difficult to do, but there are others around here who have been more successful at it than I, and clearly that's the way to go. I'd like to say a word about governance because that's such a critical part. You've got to have a very effective committee, and the committee has to delegate a lot of the responsibility to a CIO, hire a CIO and compensate him enough to keep him, and then place your confidence in him. Most all of the successful funds, whether endowment or pension, have committees were very good and have been delegated to an outstanding CIO and his staff. The composition of committees varies quite a bit across the board. Many of the large universities have committees with great deal of people with a great deal of investment experience. Most corporate pension funds, or for that matter, public pension funds, have more lay people. They may be finance experts, but that's very different from investment experts, and they need to know their limitations. I have always felt that the number one responsibility of the CIO is the education of the investment committee. Can't be going in one direction and the committee in another. Got to bring them along. And I was fortunate to have a committee at Kodak of corporate executives. They were not investment experts, and they knew they weren't. They were willing to come to, over 16 years, we had 7 off-site seminars for 2 days where we got great people to come and open up their minds. People like John Templeton, Ray Dalio, Roy Neuberger, Jeremy Grantham. We would ask them 15 questions, up to 15 questions if the time permitted, and they'd go around one after the other and give their comments on it. The first conference we had, our committee came to me and said, "Good grief, they don't agree with one another, do they?" But that was one of the great first learnings of our committee. And our committee was willing to allow us to do a lot of things that many corporate pension funds weren't allowed to do. I remember going to a conference one time, and there was, you begin to swap ideas, what you're doing. And I mentioned what we were doing at that time. And the director of another corporate pension fund looked at me and says, "You're doing what? I'd be laughed out of the room if I brought a recommendation like that to my committee." That, I felt, was a very sad commentary on the open-mindedness of the committee, maybe on the amount of education that the CIO had done with the committee. But that should never be the case. I'm getting close to my end of my time. I'd like to talk about committee meetings. and the role of bringing investment managers into committee meetings. Perhaps what I think is the worst is to have a beauty contest of several investment managers for the committee to pick. I hope that's not being done anymore, because in 20 minutes, a committee can learn how articulate an investment manager is, but my experience has been there's virtually a zero correlation between articulateness and good investing. And only somebody that's at it on a full-time basis, like the CIO and his staff, has the opportunity to discern. He should be making recommendations to the committee. I've also sat for much longer times than I would like to at meetings where they brought investment managers in. They didn't do this, Kodak, to give 20 minutes review of what's been going on with that manager. That manager spends part of his time on economic matters and very little time on why he's doing what he's doing. In fact, you wind up having a very myopic review, which could be much more effectively done by the staff. It's all right to bring investment managers in sometime for the broader education of the committee, but to give reviews, that should be done by the staff with a forward-looking, what they've done impact on what we should be expecting of them in the future. The whole committee meeting should be more forward-looking than retrospectively looking, only retrospectively if it serves the purpose of looking forward. At any rate, I could always go on, but I'm going to stop at this point, Alex.
It's a shame that Rusty only had 12 minutes. We should allocate him 2 hours. I can tell you, I've known Rusty for 20 years, and I've probably met, not everyone, but I've met most of the major pension fund CIOs, endowments, foundations, sovereign wealth funds, and in my opinion, Rusty's the best that ever lived. He could go on for a long time, and every single thing he's saying to you, you cannot believe how important each one of those things are. I've never seen anybody who deeply understands, who makes the effort to deeply understand what is actually going on, deeply understand the managers, a combination of creativity and discipline, just incomparable. Nobody compares to what he did in the time that we interacted with him before he retired. The intensity of the questions, what he used to do, just one quick thing, what he used to do is he would meet every manager once a year. He had a staff of 3, him and 2 others. He met every manager every year. He would send us a questionnaire about 6 weeks before the meeting, maybe a couple months. The questionnaire is this thick. The questionnaire included all the things we said last year. Are we still doing that? What were the results of that? What else are you thinking about? And we would go through this questionnaire. We'd have to basically enlist the whole company to fill out the questionnaire. And then Rusty would show up we'd have to send it to him weeks in advance. He would show up having read it, made notes and questions through and through, challenged us for probably 3 hours, Ray, me, and the team. Then he'd go back to his office and he'd send us 20 more questions. And they were good questions. So we have the Kodak collection at Bridgewater, which is all of Rusty's questionnaires. But anyway, you guys are very fortunate to hear his advice. As far as me, what I wanted to do is just hit you with a couple of basic concepts that are largely a reiteration of what he said. I just want to hit you with a couple of basic ideas that I think they're at the root of what we do and how we manage money, and I think that they're also universal. And so, 3 basic points. Okay, point number 1 is that you can get a lot more mileage out of risk reduction than return enhancement. You can get a lot more mileage out of risk reduction than return enhancement, and I'll show you an example in a minute. Second point is, don't believe the numbers. Okay? He said that. I'm saying, don't believe the numbers. Third point is, you have to understand the fundamental determinants of return and then balance those determinants. Okay? So I'll just quickly demonstrate and give you a couple examples of these points. The first point I said was, I can't hardly help it, I have to have a marker board to write on, I'm sorry. If I wasn't doing that, I'd be scribbling on the back of this pad and trying to show you. So, but the first point I made is that you can get more mileage out of risk reduction than return enhancement. Okay, and let me just show you a little example. If you look at, it's okay for me to walk around, right? So, if I have a strategy that makes a 1% return with 3% volatility, that's actually a pretty good strategy. It's hard to find those, actually. If I had a 1% return with a 3% volatility, okay, and if I only have one strategy, then I have a 1% return with a 3% volatility. Now, I can try to get that strategy better and boost this return. Maybe if I doubled it, it's 2%, right? Alternatively, I can maybe find another strategy that has another 1 and 3, and maybe another one, and so forth. And as I add these together, and if these are relatively uncorrelated, what I end up with is a portfolio here that maybe has a 1% return because all these strategies have a 1% return. But as I add more of them, I start to reduce the portfolio risk, and my portfolio now has a 1% return with 1% risk. Right? Now, I haven't gotten any wealthier because I'm still just making 1% return. But if I now leverage that by 3, I have a 3% return with 3% risk. And so if you look at what just happened there, we just tripled our return without changing our risk. But we did it by reducing our risk by 1/3 without reducing our return. And then transforming that through leverage. Now, if you look back at Bridgewater, this is the history of Bridgewater right here. I just gave it to you. The average market that we trade, we've made 1% return with 3% risk. We've had a 0.3 ratio by market. Our overall ratio is about 1. The difference between these two is diversification and portfolio structuring. So 2/3 of our performance has come from balancing risks well, and only 1/3 has come from trying to get the bets right. Of course, if you don't get the bets right, you don't have anything to balance, so you have to start there, right? Okay, so that's point number 1. You can get a lot more mileage out of risk reduction than return enhancement. Number 2 is that don't believe the numbers. Now, I'm going to make an assertion here. I don't know if you've ever heard this assertion before. My assertion is that correlation is unknowable. So we talk about portfolio mean variance, right? Correlation. My assertion is that correlation is unknowable. I'm talking about the correlation of any two assets. Unknowable. Okay? Now, I'm going to try to prove that to you on a chalkboard. So let's just say that I have stocks and I have bonds. Okay? And the question is, what is the correlation between stocks and bonds? Well, correlation is the way that the returns correlate. It's how the returns relate to one another. In order to understand how the returns relate to one another, you have to really understand something about what drives returns. Okay? Well, there's more than one thing typically driving the return of any one asset. Let's just say I've got economic growth here as a factor that drives the return of stocks and bonds. Okay? Now, if the economy is strong, that will be good for stocks, right? Generally speaking, if the economy is stronger than expected. If the economy is strong, that'll generally be bad for bonds. Okay? Economy is not the only thing that drives their returns. Let's say I've got inflation here as a factor that drives their returns. If inflation falls, that will generally be good for stocks. Right? If inflation falls, that'll generally be good for bonds. So inflation is working the same direction for stocks and bonds. Economic growth is working opposite directions for stocks and bonds. So now the question is, what is going to be the correlation of stocks to bonds? I don't think you can possibly know. You can't know unless you know what kind of environment you're going to be in. Will I be in an environment that's dominated by inflation? If I am, they'll probably have a positive correlation. If I'm in an environment that's dominated by economic growth, they'll probably have a negative correlation. But if I knew what kind of environment I was going to be in, I'd just go bet on that. But if I'm trying to passively structure a portfolio that's balanced, I don't have any idea what the correlation between stocks and bonds is going to be. And it's not, and what it was in the past really has no bearing on what it'll be in the future. So now what do you do? How do we do mean variance optimization when you can't possibly know the correlation of two assets? Right? So what I'm saying is you can't do this. Okay? So what we try to do is we don't pay any attention to the numbers. We never try to look at the correlation between any two assets. What we try to do is balance our exposure to economic growth and inflation. So given the structural characteristics of assets, they will perform a certain way given a certain economic environment. And you can look across your assets and start to think about how you're balanced against the economic environment through your asset holdings. So that page 26 that Alex referred to is part of that process that we're talking about. The last point is that you need to understand the fundamental characteristics of the returns that you're operating with. And the most important characteristic of those returns is how is the return derived? Is the return derived from beta or from alpha? Beta means the return is derived from the risk premium embedded in the asset. Risk premiums over time will be positive in order for the capitalist system to function. Risk premiums will be positive over a very long period of time, but it's very easy to buy a risk premium, so it's not a really good returning source of return. It's not a very consistent source of return because it's very attractive. Lots of people buy it and they bid up the price, and it maybe has a ratio of 0.25 return to risk ratio. So a beta is one kind of return. Okay, it's one type or category of return. There are lots of betas. Okay, alpha is totally different. Alpha is a bet. I got a view. If there's timing involved, I'm long. Now I'm short. Now over time, people might make bets, but they might on average be long. Then on average, they have a beta in their return, right? But so the question is, are you generating your return through beta or through alpha, through risk premiums, or through timing of bets? Because the characteristics of those is radically different. And the ability to produce a very high return is inherently limited if you're basically holding betas, because betas tend to be pretty expensive. You only got about a 0.25 ratio. No matter what the historical numbers are, don't believe the numbers, no matter what the historical numbers are, the return to risk ratio of a beta is probably not above 0.3. Okay? May have an option characteristic that makes it look that way, but it's not above a 0.3. And they tend to be very highly correlated because betas are all related to the same economic environment, so it's hard to get a lot of diversification in betas. Therefore, it's hard to get a really high ratio, high consistent return from betas. On the other hand, alphas are very uncorrelated, but you never know if you're going to make or lose money because alpha is a zero-sum game. So it's entirely a bet of can you bet on and find the right manager who can take money from somebody else, right? And if you think you can, you probably should, as a test, you might want to think about who they're taking money from as a cross-check on your process, because somebody's got to take money from somebody else when it comes to alpha. For every winner, there's got to be a loser. Now, I just want to show you a quick example of the importance of understanding the composition of beta in the returns of a manager that you might hire. One of the things that we did was that we looked at, we have like 2,700 managers, hedge fund managers in our database, and we run the calculations and calculate how much beta is approximately in the returns of these various managers. Well, we did that up to the beginning of the crisis in July 2007, sort of quantified how much beta was in every single one of these 2,700 managers. And then we looked at how those managers then performed over the crisis period, once you pop that chart. And so this is what this shows is this is the amount of beta that was in their portfolio up to July 2007. So this is more beta up here, lots of beta, not very much beta down here. And that column right there is their return to risk ratio. In other words, these guys down here lost a lot of money. Those guys up there lost less. Hardly anybody made money. And you can see that the dots are right on the line. So the amount of beta in a hedge fund's portfolio was, I think it was, 96% correlated to what their performance has been since July 2007. So if you just knew that one thing, how much beta is in their portfolio, you would have been able to identify with a 96% correlation how they would have done through the financial crisis. Same thing is happening going forward, because if you actually monitor this through the crisis for those managers, that beta hasn't changed. They still have that beta. Now, so if their particular beta does well now, they are going to look good. But it's because that beta is in there. So are you betting on the manager, or are you betting on the market that they're involved in? It's absolutely crucial for you to understand that. And if you're betting on the market they're involved in, no matter what their historical ratio is, the ratio of the beta is inherently limited to something like 0.25, 0.3.
Well, my comments will be much less erudite than those that you've heard already. Steve asked me to focus on a little bit of more stories than giving a talk, and what I'd like to do is to give a little bit of the history of how we started out the best practices in this booklet and focus. The primary departure, I think, of this publication from conventional practice is really an emphasis more on qualitative factors and what I would describe as judgment than is typically the case in structuring portfolios historically. And I was looking for a quote that might characterize what I'm about to say, and I came across something by Aldous Huxley, the English author, and said that men, and I presume if he were here tonight would say women as well, do not learn from history. That men and women do not learn from history is the most important lesson that history has to teach. And it's important to look back as to how we got to where we are. And what I'd like to do is to give you about 5 minutes of perspective on that that started certainly before most of you were involved in this industry. I had the good fortune of being in San Francisco in the early 1970s, which was something of a hotbed of quantitative thought and approach. And at that point in time, I was one of the co-founders of Callan Associates, and I was the techie in the group. Now, that may surprise some of you who know me now that didn't know me then. But, of course, techie in those days meant that you knew how to turn on a calculator, and you knew a little bit about punch cards and that sort of thing. And the leading edge was a 4-function calculator that would multiply, divide, add, and subtract. So it was not as much of a challenge as it might be today. But during that period, you had a real transformation in the way that assets were being administered. You had endowments and foundations that were diversifying from the stock of the entrepreneurial benefactor that created the foundations. You had endowment funds of universities that were waking up to the fact that bonds had not been productive for many, many years and were looking for other opportunities. And you had pension funds that were becoming quite large pools of capital relative to the size of the companies. And across the street from my office in San Francisco was Wells Fargo, and there was a gentleman there named Bill Faust who I think single-handedly was responsible for starting the first index fund that was brought into existence. And down the road was a young professor who was trying to make a name for himself, and that was Bill Sharp. And across the bay was a fellow who was just getting started out to create quite an empire, and that was Bar Rosenberg. And so there was a lot of quantitative thought that was going on at that point in time. And in the 20s and 30s, there was a lot of focus on long cycles. But as the more statistically oriented people got involved with this, the focus on cycles really subsided. And there were efforts to quantitatively characterize security prices and security price movements and that sort of thing. And that was really the genesis of the efficient market theories and the mean variance analyses to describe how securities behaved. And this whole concept really was cooked up, if you will, in the 70s and really took hold in the 80s. And I was in the consulting business at that point and working with a number of different plan sponsors, and of course we were trying to come up with clever ways to convince people to do things that they were somewhat uncomfortable in doing. And these techniques were certainly good ways to do that. And the one thing that was extraordinarily useful is that they provided some aids to judgment. Now, there are a few legendary investors that exist, but most of us in this industry are technicians that are administering a process, hopefully with some skill, but nevertheless not making heroic investment-related decisions. And this was a way to equip every man, if you will, to oversee these pools of assets in a professional sort of way. The good fortune was that it provided the fortitude to stay the course during difficult times, and it also provided some career risk cover in the sense that if something was going wrong, it wasn't because I made a stupid decision. It was because the system was temporarily out of favor and would come back into favor and so forth. And that was kind of the process, being slightly cynical about it, but that was the process that we went through during the 80s and the 90s to bring quantitative tools as really the primary drivers behind asset allocation, portfolio construction, evaluating managers, and so forth. Obviously, there was an intellectual process associated with it, but it was really underpinned by these quantitative tools. What was missed in this process that I think people are suffering from now is the idea that equity investors, for example, are entitled, if you will, to a 9 or 10% rate of return with a teen standard deviation. And technically, over time, that is valid today, just as it was when the ideas were first documented. The thing that it missed was the notion of the cyclicality that had been the focus of so many economists in the 20s and the 30s, but that notion had kind of gone by the boards during the bull market of the 80s and the 90s. And what was kind of a novel concept, a leading-edge concept early on, really became the received wisdom, if you will, by the time of the late 1990s. And the problem that investors are suffering through today is that many of these same concepts are being applied without judgment. And this has basically led many endowments and foundations and pension funds and personal investors into a much more difficult predicament at this point in time, as the focus is on quantitative approaches and style boxing and things of that sort. Now, how does this relate to alternatives? Well, the rigid oversight, as Rusty alluded to in some of these alternatives, and I include real estate, private equity, and hedge funds, which is the primary focus of this piece, they simply did not fit into any of the boxes that were created. There was a comfort zone that was basically stocks, bonds, and treasury bills that were kind of the three alternatives, and those were the choices. Those were the ones that fit neatly into this matrix of relationships. And the word alternative really says it all. It's kind of, if you've tried everything else, then maybe, and that didn't work, maybe this is the alternative that might do you some good. And the whole idea that this was an off-the-beaten-path notion, I think, is really driven by the fact that it did not fit into any of these style boxes. The flexibility of hedge funds, for example, creates an asymmetrical distribution of returns, and of course the underlying notion of the mean variance concept is a normal distribution, a bell curve, and that sort of thing, and the whole essence of hedge funds is an asymmetrical distribution. In other areas, as Rusty mentioned, you simply do not have the pricing for real estate or private equity to plug it into the models in any sort of sensible way. So where we are now, I think, is that we are beginning to see a resurgence of judgment. And as you read the piece, I hope that it comes through that there's more of an endorsement of going out on a limb, if you will, making judgments, obviously with a factual basis for the judgment, but more qualitative and less driven by the numbers. And that's really the thrust of it. And why is this getting considered? Well, I think the bottom line of it is that we've gone for a decade now with zero returns. It's the rare institution or individual that has achieved over the last 10 years anything close to what they were hoping to achieve when they set out for the decade. Investors are rethinking the rigidity. They're focusing on more innovative and opportunistic ideas. And wealthy individuals and family offices really led the way into investing in alternative investments, and they were the early adopters. These were driven by the entrepreneurs, by the drivers that were focusing on their own capital without these external institutional constraints. And they really led the way into the alternative space. The endowments, which were really driven by these wealthy individuals that tend to be major contributors to the universities, they're on the boards and so forth, they were the ones who led the university endowments into this area. And at this point in time, the rest of the world was catching on. They caught the disease in 2007. They've retreated a bit, but perhaps they will catch it again at some point in time to some degree. And I guess our hope is, as we circulate the best practices piece, as Alex mentioned, that perhaps we can all up our game just a little bit and do a little bit better job in this area. And I'm hopeful that people will be more comfortable in making judgments based upon what we've attempted to put together. And again, being slightly cynical, I hope that they can make these judgments and get into this area in a more active way than they've been comfortable in the past before the next bull market arrives, when frankly you don't need alternatives or anything else. Just put it all in equities and enjoy the ride.
Thanks. As promised earlier, you sort of heard from three legends in the business, and I'd like to turn the floor over to questions now for anyone for our panel.
We're looking at beta versus alpha in the context of in alpha, there's actually a lot of beta. For example, timing. You mentioned timing. Some people would argue that in certain strategies, timing is really a beta bet as opposed to an alpha bet, especially in longer dated type of investments.
You just have to look at how somebody makes their decisions. So, for example, if you look at what we do, right now we're long bonds. Okay, there's risk premium there that we're earning today by being in a long bond position. But if you look back at what we've done historically, we're long half the time, we're short half the time. There's no systematic bias to be long bonds. And if you understood our process, you would know how hard we try to make sure we don't have that in there, right? So literally indicator by indicator, market by market, we are approaching it with an express purpose of not having beta in our alpha. And we try hard to not let it get in there. At any point in time, you could be long or short of market. You don't have to always be, market neutral. But what I'm referring to is a systematic orientation toward beta. So like when I show you those charts, what I'm saying is that the amount of beta that was in those managers' returns was measured by a static holding of asset classes over many years basically was 80% correlated to their return. So that they are over time largely in a beta position. So you just have to understand the nature of their investment process.
Despite the fact that so many of us think about absolute return investing and no benchmark, we all gravitate to a benchmark. And I was just wondering what the panel thought about if there's a different way of thinking about benchmarks, because I think that puts us into boxes, and I don't have any ideas, but maybe has there been some thought about not looking at benchmarks as much as we do, and thinking how do we evaluate ourselves, or whether a manager's done a good job, or whether an endowment has done a good job.
I don't know. Rusty, you sort of lived that world for a long time, so why don't you give a stab at that?
The most common benchmark I've seen used is a poor one. And that's how other funds are doing in our general neck of the woods. I think the important thing is how are we doing against our own private benchmark. For all the problems that go with a benchmark portfolio, a policy portfolio, that policy portfolio is probably the best benchmark to use. To use it slavishly is unfortunate, but I don't know of a better benchmark to use than a policy portfolio. That does not mean that you should invest the same way as a policy, but if you're going to deviate from it, you should be held accountable for it. At least, see what my friends here think about that.
I'm not sure that you have any alternatives, quite frankly, to having some kind of sensible benchmark with a sensible, well-thought-out reference point. I know that some of the more successful programs that I've been involved with have had enormously variable asset allocations over time that have been driven in a very opportunistic fashion. There's always been a short-term benchmark, but as the opportunistic decisions have changed, then of course the benchmark is modified to reflect what you're doing. The risk, I think, is that over time you tend to become a benchmark hugger, and I think there's real danger to that, and it becomes very difficult for investors to conduct themselves, or plan sponsors or those overseeing the programs to conduct themselves in a contrarian fashion. And I think that you have to be prudently bold, which basically means that within the realm of common sense, you're focusing more of your energy on the things that have done poorly in the past and less energy and less allocation on the things that have done well. That's an extraordinarily difficult thing for a committee to do. And I think that as you look at the most successful investment programs out there, a great deal of the credit for this goes to the governance body, whatever that may be, that has been willing to make changes over time and to give the support to the CIO or the person responsible for the day-to-day oversight, to give that person support while things are actually going badly, because they always are going badly almost half the time. If they could be a little less than half the time, then you probably have a good return over time, but there are always times when things are not going the way you would like, or at least some part of your program, if you're diversified, almost by definition, some part of your program is disappointing you, while other parts are hopefully adding value. But in terms of benchmarks, I think that that in this environment you have to have a standard that is defensible, that's well thought out, but you have to be willing to change that standard in a way that is opportunistic as opposed to trend following, in my opinion.
The way that we, I think you have to, your benchmark should be your goal. So, but then the goal could be different for one person versus another. So you have to think about, what is my goal? Am I achieving my goal, beating my goal? So if I was going to break it down, it's really important to go beta alpha. And so if you're benchmarking your beta or your asset allocation scheme, that should largely be against cash, because I'm trying to take risk premiums instead of cash. And so how much excess return do I expect to make from that asset allocation scheme, and what range do I expect around that? And now as I experience those results, are my returns actually within that range of expectations? So I'm really measuring the performance of my beta against a return and risk expectation over cash. And then the purpose of alpha is to beat the beta, because you can always get the beta for free. So so that the benchmark for alpha is the passive alternative. So you're benchmarking your strategic against return expectations, and you're benchmarking your alpha against your passive. That's how we layer it.
I think a lot of the points we also try to cover a bit in the publication, that it does come a bit back to the institution. I think the question of relative versus absolute is always trying to get at the real question of what is value added. And there's a lot of focus on the industry on the quest for alpha, so to speak. But I think if you were to ask 3 people in this room what the definition of alpha is, you'd probably get about 4 answers. So the real question is, what are you trying to do in getting value add other than exceed a simple passive benchmark? And secondly, how is that going to influence people behaviorally? That tends to lead you in a couple of directions. One, in terms of more complexity. I'll give you an example of that. Our equity mandates are benchmarked not against an overall equity index, but every security selection decision is against a sector in a country. So you get 6 major countries, 10 S&P sectors, so we have something called 60 cell, which, if you can imagine the operational complexity behind that, but every active choice is done against a very specific subsector, so that that's taken out. The question is, though, and gets back to that behavioral one, how is that going to influence people, and can you even think intuitively about that when you're in 60 different dimensions? And so there is something to be said for simplicity, because the reality is that the very best tech fund manager in 2002 might have exceeded his peer group by 5%, but that meant they were only down 90% as opposed to 95%. And that's not going to solve anybody's problems. So.
I have a different kind of question. What about, Rusty, you mentioned that managers probably shouldn't be sitting in on committee meetings, but what about the role of consultants? How should they be involved? Should they be on a fiduciary role? Should they be put in a box and only help select managers? What's their best practices?
There are 2 different kinds of roles for a consultant. If we have a small fund, we don't have a CIO, we don't have a competent staff to rely on, we've got to find a consultant to rely on. And the consultant should be one who comes in and tells us what we should be doing and gives us the education that involved that a CIO should be providing. They shouldn't be asking us what we want to do, because most of us don't know what we want to do in that kind of situation. They should be leading us. If we have a large fund, as we had, and many of you in the audience have, then the consultant is a different role. He's an addition to our staff. We used a consultant once we got really going to do studies and give us input on things that we were not as able to do ourselves. It was an incremental thing. We never went and asked the consultant for a good housekeeping seal of approval on what we were doing. Most of the time, he didn't know who we were hiring or terminating until that happened. So those are 2 very different uses of a consultant, and they're both very important. You've been a consultant.
Ed is strangely silent on this one.
Well, I've been on all sides of this this issue as a consultant, as a trustee of plans that use consultants, a trustee of plans that don't use consultants, and running a diversified investment program as well as a fund of hedge funds. So I think it really is, as Rusty said, it depends on what you need. But as I've looked at the evolution of consultants over the years, I think that there's, as I was traipsing around with John Casey and Steve Rogers many years ago, I think we considered it to be our mission to push clients to their threshold of pain, if you will, in terms of doing innovative things. That was a very entrepreneurial kind of environment, and I think that if one pushed one to one's threshold of pain in the last few years, you would have pushed them over the edge in that environment, because it typically involved a sense of being rewarded for risk. But in today's environment, the consultants that I meet, I think, are very talented, very skilled in many ways, but it appears to me that the focus has really shifted much more toward being a service agent, an extension of the staff saying, let me help you do what you want to do, as opposed to expressing a significant position and saying, I think you really should ramp up in this area or that area. There are certainly exceptions to that, but for the most part, I think that consultants have taken on a service function as an extension of the staff, and what their duties are really is to fill in whatever holes exist with the sponsor of the investment program.
Unfortunately, we're sort of running a bit out of time, so what I'm going to do is pass the mic back to Steve, and if you do have questions for everyone, you have an opportunity afterwards to come and ask.
Thanks, Alex. Tonight's session is underwritten by the Common Fund Institute. The Common Fund has given us the creative freedom to do whatever we want to do and talk about whatever we want to talk about. But also, Common Fund does have a point of view, and John Griswold is the executive director of the Common Fund Institute. And I'd love to hear what you have to say or think about, John.
Well, I'll keep this brief with so many legends up here. It's interesting. I spent the week at Yale running our endowment institute for nonprofits, and many of whom are large endowments and foundations. I don't think there's any more agreement on this than there was when this was being put together, and I think that's a benefit of this sector and this, frankly, investments in general. I think the best practices that we embody here at the Roundtable are very often the result of a sort of a group therapy session, whether it be a small group or a large group. But the benefit and the strength of this organization is that we all get together, we discuss issues, and we argue. But we probably come up with a pretty good idea of what the leading edge, if not the bleeding edge, is in alternative investing. And that part of the investment markets is ever more important. The endowment model is being challenged by this crisis like never before. I'm not even sure there really is an endowment model, but Andre Perel at Harvard has called it a combination of highly diversified assets, low fixed income, high equity exposure, of course, no cash, a few other small characteristics. But in fact, if you look at Yale's endowment, which has been held up as one of the best in the business, and the characteristics of that endowment, they have a very, not rigid at all, but it is still a long-term, fairly steady-state policy portfolio. The average manager tenure in that policy portfolio is 17 years. They have not deviated from that policy portfolio seriously in a matter of years that I know of, and in fact they're taking some of the heat for having positions which are highly illiquid. That doesn't necessarily have anything to do with their policy portfolio. It has more to do with the external environment, but nevertheless it's put them in a cash squeeze, as it has at Harvard and other large institutions. So I think it's interesting that we're going through the sort of the teething pains of a new era here in this document. Transparency is coming to alternatives like never before. Those of you who read some of the statements from me coming out of the Senate and House yesterday in the hearings know that's true. But it's really, transparency in our way of thinking is hugely useful to investors, of course. It may be anathema to them because they in fact like the lack of transparency in some cases where they're proprietary strategies. But it's part of the learning that occurs, and it only is useful when learning occurs. Transparency, for the sake of transparency, really doesn't serve much purpose. I was fascinated by Rusty's statement that good governance is one of the most important things. We believe that for a very long time at Common Fund, and I think we've demonstrated that in our clients' work to try to improve the process of decision-making and investing for a long time. A lot of the work we put out and we try to do in our educational programs is based on improving good governance. There's clearly performance, as Rusty said, is based primarily on good governance. And the key to good governance is clearly education. Education of decision makers, both initially and in continuing education. And that's really what this volume and this organization embody. So I want to thank Steve for inviting us to sponsor this. It's been an education for me to go through, at least on the sidelines, watching this process. And I commend you to read this and think about a lot of the things that it says in the volume. Thanks, Steve.
Thank you, John. This is the time where I embarrass you all. When I read your name, if you would stand up, but I'm going to read some names of people who aren't here who helped us. First and foremost, Peter Bernstein, Charlie Ellis, Clark Binkley on timber, John Hill on energy, Ryan Dartnell from the family office perspective, Peter Lawrence and Sue Carter on venture capital and private equity, Alexis Palmer on private equity, Mary Cahill on the endowment perspective, Ray Dalio and Mark Casello on portfolio construction. Nathan Fisher, if you would, please stand up. Mark Silverstein, please stand up. Ray Gustin. Alex Piletsky. Keep standing, fellas. Keep standing. Alex Piletsky. Rusty Olson, if you would stand up, sir. Ed Barksdale. Alex Weiler. These are the people who wrote this document. It took them 2 years. They weren't paid, and it was a lot of work. Let's give them a big hand.